Most people think finance is still controlled by physical banks, branch offices, and slow settlement systems. But in reality, the global financial system is being rebuilt into a programmable digital infrastructure operating in real time. A new financial architecture is emerging, one built on APIs, artificial intelligence, embedded finance, and instant capital movement across global networks. This is what many now call Digital Finance 2.0. At its core, this trend is about replacing legacy financial rails with software-driven systems capable of moving money, credit, and financial services instantly across the digital economy. And this transformation is beginning to reshape banking, payments, commerce, lending, investing, and global capital flows. To understand why this trend exists, you first need to understand the structural pressures driving it. One major driver is open banking regulation. Governments and regulators around the world are forcing traditional institutions to share financial data through APIs, enabling entirely new financial applications and competitive ecosystems. Another major shift is the rise of the real-time economy. Modern commerce increasingly requires instant settlement, continuous financial access, and 24/7 capital movement across multiple time zones. At the same time, legacy banking systems are struggling to keep up. Many traditional financial institutions still rely on aging infrastructure originally designed decades ago for batch processing rather than real-time digital transactions. And behind all of this is the explosion of financial data. Massive digital footprints are allowing artificial intelligence systems to make faster and more accurate decisions related to credit, fraud detection, and financial risk assessment. Today, Digital Finance 2.0 is increasingly becoming the new operating system for global commerce. To understand how this ecosystem works, you need to break it into 5 major pillars. The first pillar is next-generation payments and digital wallets. Consumers are moving beyond physical cards toward biometric authentication, mobile payments, and contactless financial experiences integrated directly into smartphones and applications. The second pillar is real-time infrastructure and APIs. This is the financial plumbing layer, the systems enabling instant settlement and seamless communication between financial institutions, merchants, and digital platforms. The third pillar is embedded finance and banking as a service. Non-financial companies can now offer banking products, payments, lending, and financial tools directly within their own ecosystems. The fourth pillar is AI lending and credit intelligence. Machine learning models analyze alternative data sources to automate credit decisions, detect fraud, and optimize lending risk in real time. And the fifth pillar is digital wealth and tokenization. Physical assets, securities, and financial products are increasingly being converted into digital tokens capable of fractional ownership and continuous trading. Behind the scenes, operating digital financial infrastructure requires highly advanced coordination systems. Companies manage secure API gateways connecting financial institutions worldwide, monitor transaction telemetry to identify fraud and liquidity risks, engineer AI models for predictive lending systems, and maintain strict KYC and anti-money laundering compliance protocols. At the center of this ecosystem is a highly integrated value chain. It begins with identity and compliance systems. Then comes the core ledger infrastructure that records and processes financial activity. Next is API integration, connecting financial services across multiple platforms. After that comes the financial application layer, where companies build payment, lending, and investing solutions. And finally, the user experience layer delivers seamless financial interaction directly to consumers and businesses. Now, who is actually buying this technology? Digital consumers increasingly expect instant, frictionless banking and investing experiences directly from mobile devices. E-commerce platforms and digital businesses require integrated payment systems and embedded financial services to increase conversion and customer retention. and small and medium-sized enterprises are increasingly using AI-driven treasury management and automated credit systems to optimize operational cash flow. Now let's talk about monetization. One major revenue source is transaction fees, generating income from every payment flowing through modern digital financial rails. Another rapidly growing model is infrastructure subscriptions. Financial technology companies charge businesses for access to banking-as-a-service platforms and API-based financial infrastructure. AI-driven lending systems also generate interest income through automated credit products and predictive underwriting systems. And data monetization is becoming increasingly valuable. Financial platforms now provide anonymized analytics, risk intelligence, and financial insights to institutional partners and businesses. Several major companies are emerging as structural leaders in this ecosystem. Visa and MasterCard are transforming from traditional card networks into global digital payment infrastructure providers. Stripe has become one of the foundational API infrastructures powering internet commerce and embedded finance. Adyen is a global leader in unified payment processing and financial technology systems. Block is building integrated merchant payments and consumer financial ecosystems. Nu Holdings, also known as Nubank, has become one of the world's largest digital banking platforms. And companies like PayPal and Fiserv continue expanding digital financial infrastructure and next-generation payment systems globally. Now let's talk about where this trend is heading next. Real-time payment rails like FedNow and UPI are accelerating instant settlement adoption worldwide. Artificial intelligence is dramatically improving fraud detection and credit modeling capabilities. And tokenization may eventually enable 24-hour trading and fractional ownership across a wide range of real-world assets. As this trend expands, industries most exposed include traditional banking, retail commerce, global e-commerce, and real estate finance. But despite the enormous opportunity, Digital Finance 2.0 also faces major risks. One challenge is regulatory fragmentation. Different countries continue developing conflicting rules regarding digital assets, privacy, and financial competition. Another major issue is systemic cybersecurity risk. As financial infrastructure becomes increasingly interconnected through APIs, single points of failure could create large-scale disruptions to global liquidity systems. Traditional institutions also face growing technology debt. Modernizing decades-old banking infrastructure is extremely expensive and operationally complex. And artificial intelligence is simultaneously creating new forms of automated fraud that challenge existing identity verification systems. At the end of the day, Digital Finance 2.0 is not simply about online banking. It is about rebuilding the global financial system into a real-time digital infrastructure layer integrated directly into the modern economy. And as APIs, artificial intelligence, tokenization, and embedded finance continue to evolve, digital financial rails may become one of the defining infrastructures of the next economic era. If you want to understand markets, you have to understand this system. Subscribe to NAVIXA for clear, structured market insights.